Right now, somewhere in America, someone just got denied a loan. Not because they're broke, not because they missed payments, because they believed something about credit scores that just isn't true. And here's the crazy part. Most people believe at least one of these myths right now, today, without even knowing it. Let's break them down one by one, because each one of these has cost real people real money. Myth number 1, closing a credit card helps your score. This is the big one. People think, I don't use this card anymore. Let me just close it, clean up my wallet. Feels responsible, right? Wrong. When you close a card, you lose that available credit. Your credit utilization, how much you owe compared to how much you could borrow, jumps up overnight. And if that card was old, you just deleted years of credit history. Length of history is almost a third of your score. So closing an old card you never use, that can tank your score by 20, 30, even 50 points. People do this before applying for a mortgage, thinking they're tidying up, and then they can't figure out why their rate just went up. Myth number 2, checking your own credit score hurts it. This one keeps people in the dark, literally scared to look at their own numbers. Here's the truth. When you check your own score, that's called a soft inquiry. It does nothing. Zero impact. The thing that actually affects your score is a hard inquiry, when a lender checks you because you're applying for credit. Checking your own score is like stepping on your own bathroom scale. It doesn't make you gain weight. But because people believe this myth, they avoid checking their credit for years, and they miss errors, and identity theft, and accounts they didn't even know existed. By the time they find out, the damage is already done. Myth number 3, you need to carry a balance to build credit. This myth alone has probably cost Americans billions of dollars in interest. People think, if I pay off my card in full every month, I'm not building credit. So they carry a balance on purpose. They pay interest on purpose. Here's what's actually true. Paying in full every single month is the best thing you can do for your score. The credit bureaus don't care if you carry debt. They care if you pay on time and keep your utilization low. Carrying a balance doesn't build anything except your interest payments to the bank. Somebody somewhere told a story once about needing debt to prove you're trustworthy with debt. It's not true. It never was. Myth number 4, your income affects your credit score. People assume that if they make more money, their score goes up. Makes sense on the surface, right? More money, more responsible, better score. But your income isn't even part of the credit score formula. Never has been. A teacher making $45,000 a year can have an 800 credit score. A person making $500,000 a year can have a 500. What matters is behavior, payment history, utilization, length of credit, types of credit, new inquiries, not your paycheck. This myth actually causes real harm because people making less money assume their score is capped low, so they stop trying to improve it. That's money left on the table, literally, in the form of better interest rates they never applied for. Myth number 5, one late payment won't matter. This is the one that sneaks up on people. They think it's just one time, 30 days late, no big deal. But a single late payment, reported to the bureaus, can drop your score by 60 to 110 points if you had good credit going in. And it stays on your report for 7 years. 7 years. One missed payment on a medical bill, one forgotten subscription that went to collections, and suddenly you're paying a higher rate on your car loan, your mortgage, sometimes even your insurance. Lenders don't see the reason behind the late payment. They just see the late payment. So here's what all 5 of these myths have in common. They all feel true. They all sound like common sense. And every single one of them is quietly draining money out of people's pockets, one wrong assumption at a time. Your credit score isn't about how much you earn or how responsible you feel or how careful you think you're being by closing cards and avoiding your own report. It's about a handful of specific, knowable behaviors. Pay on time, keep old accounts open, keep balances low, check your report often, pay in full. Do those 5 things and you're not fighting the system anymore. You're playing it the way it was actually built. And that's the difference between a credit score that works for you and one that quietly works against you for years without you ever knowing why.